accounting concept. Okay. Let me do the
Okay.
recording. It's a bit lagging. So get ready for next week. Huh?
Next week, Friday, right?
Yeah, Friday night. So you might combine with other classes. Okay, you know how to, upload into the Google form using Google form, isn't it? So you have been practice using that technique. I mean that method. So that shouldn't be a problem. Okay, you just need to practice how to use the Excel so that you can answer all the question on time. All right. So we move on to chapter 6, non-current asset. So as you all know, non-current asset is referring to the statement of financial position item, the first type of asset. Okay, can you see? All right. So in this chapter, remember, non-current asset is referring to the first type of asset. So in this topic, you should know to differentiate between capital expenditure and revenue expenditure. So expenditure means spending, expenses, same meaning, expenditure. So one is treated as capital expenditure and one is revenue expenditure. Now, what is capital expenditure? Meaning that expenses is not being, expense in the same year, but it is being capitalized. Capitalized meaning they hold that amount, they put that amount into an asset, yeah, using the asset concept, and then they will, allocate on year by year a certain amount which is considered as depreciation and put as an expenses. So that is the meaning capital expenditure. Revenue expenditure meaning as you incurred the expenses, you immediately put that as an expenses, not an asset. Can you understand what I'm saying? So put into an expenses meaning at that particular of time, particular period, they will, match against the revenue in order to get the profit. So that is uh, the basic difference between capital expenditure and revenue expenditure. And you should know the nature of the non-current asset. Depreciation. These are all the terms that you will see. Depreciation, useful life, scrap value, accumulated depreciation, and net book value. Now, non-current asset like motor vehicles. Okay, focus on motor vehicles. Look at the nature of the motor vehicles. You can use more than 1 year, isn't it? But as years passes by, like year one, year two, year three, you find that your motor vehicle in terms of value is depleting, meaning the value is going down, okay, due to the physical condition of the asset itself, isn't it? So that is the nature. So that is why we have to estimate part of this expenditure, yeah, on the non-current asset to be put as an expenses. So that's why this depreciation comes around. Okay, this depreciation existed. Okay, they call it depreciation, a special term. Okay, which is uh, the expenses to reflect the nature of the non-current asset. We call it depreciated, but we call it depreciation, not depreciated. That is past tense. Okay, so depreciation. And how this depreciation being calculated? So one of the component will be this one, useful life. Useful life is referring to uh, how long, how many years I mean how many years this non-current asset can be useful. Okay, so sometimes it's 5 years. So we divide by 5 years. Scrap value. Now, scrap value is at the end of the useful life. So you have the remaining value of this particular asset. That's why we call it scrap value, or we call it residual value. Same meaning. Now, and remember the depreciation, okay, is reflecting the nature of the non-current asset. Is considered as an expenses that is used, okay, on the non-current asset. So, like what we have learned, if there is, I mean, this is expenses. So you have a debit. If there is a debit, there must be a credit, isn't it? So the credit, because this depreciation is not actually paid by cash, it's just an allocation. Allocation means we only provide that value, then that is debit. But what do we credit? So the credit will be this one, accumulated depreciation. We accumulate the depreciation that we have allocated in that particular non-current asset. And the difference between the cost with the accumulated depreciation will be known as net book value. So these are all the terms. It is related. So you relate from one to another so that you can remember correctly. Okay. And later you will see how to calculate depreciation. We have two methods. One is straight line and the other one is reducing balance method. So probably Noel have learned this. So we have garis lurus and the other one is baki berkurangan. Okay, in Malay lah. So but in English, straight line and reducing balance method. Straight line is more simple. Reducing balance method, not that hard, but you have a few process. Okay, cost you less with the cumulative depreciation, then the net book value, isn't it? So the net book value, then you apply with the percentage. Okay, whereas straight line, the percentage you times with the cost. That's all. And then we record. We need to learn to record the depreciation in the prime entry. So the prime entry, this depreciation is not cash, meaning there is no cash payment, so it's not in the cash book. So this is not related with sales cycle. So not sales journal, return inward journal, and not related to purchase journal, not related to purchases activity cycle. So it's not in the purchases journal, not return outward journal, not petty cash as well. So, but it has to go to one of the 7 prime entry. So the prime entry will be general journal. Okay, so we need to learn how to record this. Normally, it will be done at the end of the year. And then from the general journal, so like the sales journal, purchases journal that we have learned, we use that as our point of reference to do the posting. Okay, so based on the general journal, so we follow the general journal, we open up account to be debited and account to be credited in the general ledger for depreciation. So just remember, depreciation is an expenses. So we debit depreciation. And if there is a debit, there must be a credit. So the corresponding entry must be credit. So what do we credit? Like what I've said to you, you accumulated depreciation because there's no actual payment done on the depreciation. And later, after that, we have to do adjustment of depreciation in the trial balance and financial statement. Okay, that's what you expected to understand. Okay, so let's go through the first one. That is capital expenditure and revenue expenditure. So remember, Expenditure, meaning money spent by the business. It is an expenses. So same meaning, expenditure meaning expenses lah. Okay, both capital and revenue expenditure are money spent by the business. So the main reason to distinguish these two expenditure because of how each of them is treated in the account. So meaning we are talking about accounting treatment for capital expenditure, accounting treatment for revenue expenditure. Now, revenue expenditure must be expense off in the period it is incurred. Expense off. What is the meaning expense off? Meaning we put into the expenses account and it will be treated as an expenses that is closed off and posted to statement profit or loss. That is expense off. Okay. When the period as we incurred. So let's say it is incurred in the year 2021, then we must put in the 2021. Okay, so that is expense off. So whatever we spend must be fully deducted as an expenses in the period it is incurred. So it cannot be carried forward to the next period. So meaning like deferring, like the asset we defer. Okay, capital expenditure we defer. We record as an asset and then we carry forward to the next following year. Okay, so because why we expense off? Because the benefit of the expenses is enjoyed in that period itself. So meaning expenses like salary, we incurred during the month of January to December. So after that, there's no more left on the salary because it's already been consumed. Okay, the service of the staff already been consumed by the business. So that is the meaning. They have, you know, the benefit is being enjoyed in the period itself. So that's why we treat it as an expenses. So as a result, yeah, the profit for that period will be reduced by the whole amount of the expenses. Okay, remember in the accounting concept that we have learned, we have to match the revenue earned against the expenses incurred. So electricity expenses is deducted in the period it is incurred. Okay, so we are observing the matching concept. Now, what about capital expenditure? Capital expenditure, these are the expenses spent on acquiring non-current asset. Acquiring, meaning we purchase the non-current asset. Non-current asset, for example, motor vehicle. We purchase the lorry, we purchase the van, we purchase the car for the business. Okay, so the value that we paid to the supplier is considered as capital expenditure, which are to be used, okay, not to be sell. We don't buy and sell. We buy and we use for more than 1 year. So then that is the concept, the general concept of capital expenditure. If you can use more than 1 year, then you treat the accounting treatment will be as capital expenditure. So a further explanation, capital expenditure, how do we classify capital expenditure? We look at the benefit. Like just now, revenue expenditure, the benefit we consume in that particular period, then after that, no leftover. But this capital expenditure, the benefit, you can enjoy more than 1 year. You can use in the first year, second year also you can use. So this is what we call the benefit can be used more than 1 year. So it is only fair that the expenses is shared by the few years that enjoying its benefit, matching concept, rather than expense off in the first year. So meaning is for fairness and for observing the matching concept, okay? Since you can use more than 1 year, so you don't expense off all the costs of the non-current asset immediately during the first year. Because you are not only using the first year, but you're using first year, second year, third year, fourth year. So by right, so we only we allocate the expenses that is being used from that capital expenditure year by year, share on yearly basis, more than 1 year, shared by few years. That is the meaning. So we are following the matching concept. Therefore, the capital expenditure allocated, spread, divided over a few years. Hence, the impact of the profit is smaller over the 5 years. So we want to, because we are using more than 1 year, it's not right to just match with the revenue one time in the first year. So the impact is so great. So your profit will be reduced, isn't it? So in order to be fair, so it will be allocated according to yearly basis over a few years. Spread it, allocate it, divide it by a few years, so that the impact will be much more smaller. So, and it's giving us true and fair view. Okay, so that is the reason why revenue expenditure and capital expenditure existed. Why this concept existed. Can you understand?
The capital example is like what?
Buying the motor vehicle, buying the lorry, the bicycle, the motorcycle, buying the building,
Does it,
furniture,
as long as it lasts
office
more than one?
equipment.
Does it, as
Yeah,
long as it lasts more than 1 year?
yes. As long as you can use more than 1 year, that is considered as capital expenditure. Okay, revenue expenditure, the sales.
Petty cash
Okay,
counts
sorry,
as
not the sales. Revenue expenditure is the purchases, the salary, utilities.
the petty cash used to buy something.
Petty cash is
Usually
different. Petty cash is
different.
an asset. But what I mean is the payment that is paid through the petty cash. This
Yeah,
is
yeah.
expenses. So that expenses is revenue expenditure. Okay,
Okay.
so moving on. Capital expenditure is incurred where a business spend money. Okay, these are the component of the capital expenditure. Buying, acquiring non-current asset. Buying meaning referring to the purchase, referring to the price that we paid to the supplier of the non-current asset. That is the first one. The second one, expenses to increase the value of existing non-current asset. Okay, increase the value, meaning these are all the incidental costs. Incidental costs meaning costs that you have to incur in order to bring the non-current asset to the business premise. Okay, I mean, let's say machinery. The machinery need to be transported from the supplier to the business, to the factory, isn't it? So the payment on the transportation is known as carriage inward. Yeah, carriage inward. So this will be considered as part of the capital expenditure. You will add with the price that is paid to the supplier. What else? Installation. Okay, let's say this machinery need to be installed by a specialized engineer. So the fees that is paid to the engineer will be considered as part of capital expenditure also. Okay, that is the meaning, expenses to increase the value. And then probably you need to buy some uh, additional. Let's say you need a casing, you need, a leveling place to put the machinery. Okay, so those costs of buying this item also considered as capital expenditure. Okay, so these assets are bought mainly for a day-to-day business use. So they are not intended for reselling value. That is the most important thing. So Capital expenditure also involve increasing the value of the non-current asset to make them efficient and effective. Let's say if they have incurred additional costs in order to ensure the machine capacity, increase the capacity of the machine, so that also considered as part of the capital expenditure. So capital expenditure include all the cost expenses to bring the non-current asset to its current location, to its current condition. So it can be used for the business. So meaning any expenses or any related costs to uh, bring that non-current asset to the current location or to the current condition. Current condition meaning making additional modification on the machinery. This is also considered as capital expenditure. Okay, so you need to read carefully of the question and see whether should you include that as part of the capital expenditure. So this is the example that you can find. Okay, capital expenditure include the cost, okay, uh, or the purchase price of the non-current asset, less any trade discount if there is. If there's none, then just ignore the trade discount. The carriage inward, so carriage inward, like what I've explained to you, that is related with transportation cost to bring the non-current asset into the business. And let's say the machinery is from overseas, we imported from Japan or from uh, Thailand. Okay, so we need to pay the custom duty. So this is incurred if the asset is bought from overseas. And then probably when you bought this machinery also, you have to sign the selling and purchase and sales agreement. So you need to pay the legal fees. Okay, let's say you want to buy a building. Okay, the building for the business. So you need to sign this S&P, selling and purchase agreement. So that will be witnessed by the lawyers. So you have to pay the legal fees. And then installation charges, like what I've said to you just now. Okay, in order to ensure the machine functioning correctly, so it need to be installed by a certain expertise. Okay, so all the fees will be considered as installation charges. Any other cost to get the non-current asset ready for use? So this is other costs like you need to buy some of special features in order to get the non-current asset ready for using. Okay, so those are the possible capital expenditure. So in conclusion, so whatever that is related costs with the non-current asset is considered as capital expenditure. Okay, this is the area that you will look into. Okay, there are 6 areas that you have to look into. And, oh, sorry, 7. An estimate of the future dismantling. Future dismantling, meaning this cost is not being incurred yet, but you have estimated. In future, if you want to dismantle this machinery, dismantle meaning you are not going to use that anymore, so you have to take it out from the present location. So that is dismantling, removing. So we have the cost to restore the site on which it is located. So we have to estimate that value and include that as part of the capital expenditure. So capital expenditure increase the value of the non-current asset in the statement of financial position. So this is telling you, okay, so in order to determine the cost of the non-current asset that you would record in the, using asset concept in the SOFP, statement of financial position. So the value is not only restricted to the purchase price, but all these 7 types, 7 category, right? Now, further explanation of revenue expenditure. So this is incurred in running the business on day-to-day basis. Running the business, sometimes you need to to pay the servicing of the machinery, the maintenance of the machinery. So this is considered as revenue expenditure. Okay, not increasing the value of the non-current asset, but it's just that maintain so that the machine can be uh, operate efficiently. So revenue expenditure charged as an expenses in the statement profit or loss. Okay, so can you see the accounting treatment different here? If it's capital expenditure, you record as an asset in the statement of financial position. But for revenue expenditure, you expense it and close off that account and put into the statement of profit or loss. Different, isn't it? One is SOFP and the other one is SPL. Okay. Now, let's go through the definition of non-current asset. Non-current asset, these are item of material value. Material value meaning the value will be more than, sometimes we have 30,000, even we have 1 million, 2 million, substantial, okay, which are to be used in the ordinary course of the business to generate income for the current and future period. So meaning it's more than 1 year, can be used more than 1 year. Okay, what for? To be used in the business. So these assets are intended for continuous use for a long period of time, sometimes 5 to 10 years or more. So not bought for resale to earn profit, but to be used to earn revenue. Yeah, to generate revenue. Now, the nature of the non-current asset. So the nature is it doesn't last forever. Okay, with the passage of time, meaning referring to as years passes by. So the value of the non-current asset will diminish. Diminish means it reduce year to year. So year one is 30,000, year two become 20,000, year three become 10,000. So this is diminished. Okay, what is the reason? Due to physical deterioration. Physical meaning as you use your motor vehicle, the physical fitness of that particular vehicle become, loosen. Last time it was fit, you can't hear any squeaking sound, but now you can hear like ning, after the third year. So this is what we call physical deterioration. Or even last time the door of your motor vehicle is good, but now is, uh, getting worse. Okay, sometimes you can't open, right? So this is what we call physical deterioration. And then outdated. Outdated meaning at the current trend, no one is using that model anymore. Like when we talk about handphone. Last time we have Nokia 3210. This is famous. But then 5 years later, Nokia 3210 not existed in the market anymore. Now people using Android, isn't it? So this is what we call outdated. No longer, and the other one is no longer adequate for the business. So probably the machine can produce 30,000 units per day. But since the demand increases, so the business need to increase the capacity of the machine. So they need to fulfill like 100,000 unit per month, let's say per month. So they have to produce according to that output, I mean the demand. So they have to find another non-current asset that can produce to that volume. Okay, that is the meaning no longer adequate for the business. So because of that nature of the non-current asset, okay, so we need to allocate part of the cost of the capital expenditure as an expenses. So this is where we call it depreciation. So this is part of the cost of the non-current asset we allocate as an expenses in the statement profit or loss. And the term that we use is depreciation. So remember, whenever you see the depreciation, so just remember this is an expenses. Expenses, so remember, is a debit item. So meaning always on the debit side. So the cost of non-current asset is allocated or spread divided over 5 years, where it is used to help generate business income. So that is defining the depreciation. What is depreciation? So depreciation is part of the cost of non-current asset which is allocated, which is spread, divided over 5 years, where it is used to help generate business income. Okay, the number of years is called the asset useful life, which is usually, this is an estimate. So the shade portion of the original cost of the non-current asset is called depreciation. So therefore, depreciation is part of the original cost of the non-current asset that are being consumed during its period of use by the business. So it represents the loss reduction in its value of the non-current asset as it is used over time. So depreciation, that is the definition. Meaning depreciation is part of the original cost of the non-current asset.
Is it count in inflation? Make the depreciation
Come again,
like
inflation.
like the money inflation make the
Okay, the inflation is another term. Inflation is like depreciation concept, but that is for in money. This one is in non-current asset.
no. So like the
Mhm.
thing become like a machine becomes less efficient over time like that.
Yeah, that is depreciation.
Oh, okay.
So from time to time, they will ask you the how depreciate. I mean, define what is depreciation. So depreciation is actually part of the original cost of the non-current asset, which they have estimate being consumed during that period of use. Okay, so meaning it represent the loss, the reduction in value, because the nature of this non-current asset doesn't last forever, isn't it?
Also, like one like last year it produced produce no this year they produce less some a little bit less than last year like that, the production of the
Mhm.
machine.
Yeah, but then in depreciation, they are not reflect like the actual production or whatsoever, but they just make an estimate. So
Oh,
normally the estimate will be like if we are, because we have two method later we're gonna cover, straight line and reducing. So if we use a straight line, we assume throughout the year they will be using the same amount. Let's say if it's 10,000 first year, second year also 10,000, third year 10,000 until the end of the useful life. Okay, so because this depreciation is like a method only, so it doesn't reflect the actual uh, reduce in value of the non-current asset. So an estimate only. Yeah. So
okay.
how much is the depreciation? How many years should be asset be depreciated? It is only an estimate, because the truly accurate amount of the loss, the reduction, you can only determine after you actually dispose of the non-current asset. Then you will get the actual. Okay. So when disposing of, depreciation represent the loss reduction when the amount is received from disposal less than the original purchase price. Okay, so depreciation is charged as an expenses in the statement of profit or loss. So this is the accounting treatment. It will be charged as an expenses in SPL. So useful life. What is useful life? Useful life is referring to the estimated number of years usage in the ordinary course of the business to generate income. At the end of the useful life, the non-current asset is normally disposed of. Can you understand? Useful life meaning this is referring to the year how long, how many years can this non-current asset be used in the business. So this one also an estimate. So sometimes 5 years, sometimes 10 years. Depend on the nature of the asset. For you, you are not going to do the estimation, but for your syllabus is you'll be given how many years. Then you use that year to calculate the depreciation. Disposal value or residual value or scrap value. So this disposal value is also referred to as residual value. So same meaning lah, okay? Which the business received at the end of the non-current asset useful life when the asset is sold. Sometimes the residual value can be nil. Now, what is residual value? From the reading, it tells us, okay, disposal value is referring to the value at the end of the useful life of the asset. Okay, how much can we receive at the end? That's why the nature of disposal value sometimes zero at the end of useful life. Okay, that is a possibility. So now normally the disposal value also we make an estimate when the actual situation happen, like end of useful life, then you can know the exact amount of disposal value. Accumulated depreciation, like what I've said to you. Okay, so since depreciation is an expenses, so it will be debit, but we must do a credit also. Where is the credit? So the credit is in accumulated depreciation. So what is accumulated depreciation? So accumulated depreciation is one of the general ledger account showing the total amount of depreciation that had been charged in the statement profit or loss over a number of years. Okay, so meaning look at the word accumulated, and then after that depreciation. So that is actually explaining to us the definition. Accumulated depreciation is referring to depreciation that had been allocated throughout the years, yeah, of that particular asset. So that is accumulated. Accumulated means we add all the depreciation we have allocated, isn't it? Okay, that is being charged to the statement profit or loss over a number of years. So those are the keyword. So it represents the estimated. Okay, what does it represent? Total loss, total reduction in the value of the non-current asset accumulated over number of years. So, okay, the first thing, accumulated depreciation, okay, is representing the amount of depreciation that is being allocated as charged as an expenses in the statement of profit or loss. And it represents the estimated loss in value, reduction in value of the non-current asset, which is being accumulated over the number of years. Okay, so it's different from depreciation. Okay, depreciation only recording the yearly basis, the yearly expenses allocated as depreciation. And accumulated depreciation, we don't record into the statement profit or loss, but then we record in the statement of financial position, and it reduces the value of the non-current asset. Meaning, you have to, it's supposed to be, because this is credit item, isn't it? Accumulated depreciation is credit item. So it is using liability concept. So it should be together with liability in SOFP. But then since this is related with the non-current asset, okay? So we have to present it together with the non-current asset. But we have to change the symbol, not plus the cost, but then we have to minus. So that explains why minus, because the effect is it reduces the value of the non-current asset. Now, net book value. So like what I've explained to you just now, net book value is the difference between the cost with the accumulated depreciation. So net book value of non-current asset is the balance after deducting the accumulated depreciation. So meaning cost minus accumulated. So it represents the estimated value of the non-current asset in the statement of financial position. So it is also known as the carrying value of the non-current asset. So the formula, this is definition. This is the formula. Cost less accumulated depreciation. So this is net book value, carrying value of the non-current asset. Okay, it will be stated in the SOFP. So we take carrying value only. So we don't take the cost, we don't take the accumulated depreciation, but we take the carrying value only. So how to get carrying value? So the cost less accumulated depreciation. Okay. Now, next thing is calculating. How do you calculate depreciation? Okay, so depreciation is only an estimate. Remember that, estimate. Estimate means not the actual figure. Okay, so representing the loss, estimate representing the loss, the reduction in value as they are being used. So as such, difficulty may arise in arriving the best estimate for depreciation amount. Okay, so there is no perfect method. So it's not the best estimate, but it's considered as a good method. Yeah. To solve this difficulty, accounting has developed some method that help business to calculate depreciation. However, even this method are not perfect. So they have to make a choice of the depreciation method that is best suited for the type of business. So we have two methods only. So this is not perfect, but well, at least we have the estimate, isn't it? So we have to select. How do we select which one? So it depends on what type of business. Now, these are the depreciation method. So we have straight line method. So remember, whenever you see this word straight line, meaning the depreciation will be same amount. Okay, same amount. So the total cost of the non-current asset are spread over its useful life at an equal amount and charged to the statement profit or loss every year. So this is describing you the straight line method. The total cost. That's why, okay, how do we, this is the formula, the total cost of non-current asset. Okay, that is first thing, acquisition cost less scrap value. So acquisition cost, these are the costs that we discussed just now, include the purchase price and any incidental costs that involve to bring the non-current asset to the current current location and current condition. Okay, so that will be your acquisition cost. Then you less with the scrap value. So the scrap value is an estimate at the end of the useful life, how much. So you minus. Then we divide estimated useful life. So useful life is the estimation number of years the asset can be used in the business. Okay, so that is the meaning. When we divide this estimated useful life, we are spreading over its useful life an equal amount. So resulting from this, yeah, just like this illustration here. So every year we are going to allocate the same amount. Okay, same amount. So like let's say this one, an equipment was purchased 55,000. So simple illustration. And useful life estimated is 5 years, and scrap value estimated 5,000. So we apply this formula. So acquisition cost 55,000, scrap value 5,000. So you minus, so 50,000, isn't it? And then divide with estimated useful life 5 years. So divide 50,000 divided by 5, so 10,000 every year. So for 5 years. So year 1, 10,000, year 2, 10,000, year 3, 10,000, year 4, 10,000, until the final year, year 5, 10,000. Okay, that is how we allocate the depreciation. So that depreciation will be the estimated expenses, okay, reduction in value that is used in that particular asset. So depreciation is an expenses, so we debit. So where is the credit? Debit depreciation 10,000, credit accumulated depreciation. So remember, this is not, there's no actual payment, yeah? Actual payment of expenses. This is just allocation. So that's why we have to do the debit entry in accumulated. So accumulated depreciation is an account, okay, represent the amount that is being allocated as depreciation and charged in the statement profit or loss. Okay. Now, same amount every year. So straight line method. Effect of straight line method, equal amount of, this is the effect. There are two effects. Equal amount of depreciation every year being charged to the statement profit or loss. Every year in SPL, it will be the same amount, expenses, depreciation. And then the second effect is the value of the non-current asset in the statement of financial position, okay, will be reduced by equal amount every year because it will be put into the accumulated depreciation, isn't it? Okay, and then the accumulated depreciation will be carried forward from 1 year to another year. So that's why when you minus with the non-current asset, like what we have just now, okay, it will reduce the non-current asset, that is the carrying value will be reduced by same amount, 10,000, 10,000 every year. Yeah, that is a straight line. Any question on this? Can you understand? Farah? Can I? Okay. Now the next one is reducing balance method. Oh, before I proceed, sometimes this one we do, if you are given the information like this, yeah, useful life, scrap value, so meaning you are expected to do the straight line method. But the other way that they would ask you, okay, they give you the percentage. So when you want to calculate, okay, when you want to calculate the depreciation, so you apply on the cost. Like this one is 55,000, isn't it? So you are given 20% as the percentage. So 20% of 55,000. So every year, 20%. Okay. Next one is reducing balance method. So the nature is decreasing about every year. Refer to depreciation charge. Huh? Just hang on for a while. Sorry. Okay. Yeah. Where was I? This one. Reducing balance method. You will be given a fixed percentage for depreciation. Okay, and then this will be deducted from the cost in the first year. And in the following year, the fixed percentage is applied on the net book value. So from this sentence, it tells you during the first year, okay, you have to times with the percentage, times with the cost. But then second year onwards means second year, third year, fourth year, fifth year. So you have to times the percentage with the net book value. So remember, net book value, cost minus accumulated depreciation, isn't it? Okay, after deducting previous year depreciation charge. So this method is sometimes known as written down value method. Okay, so the name can be, in the question, they can either put reducing balance method or they call it written down value method. So it's the same thing. Okay, so how do you know it's the same thing? Because you see, written down value method meaning the percentage you apply the net book value, the written down value, isn't it? Let's go through this. So you use this format. Huh? So in columnar form. So the first column, this is the first column. This is representing year. The second column is the date column. The third column is the particular column. And the last one is the value column. Okay, so look at the question. An equipment was purchased at 50,000. So depreciation is charged on reducing balance of 20% per annum. So this is the fixed percentage. So this is the cost. So the first year, let's say we bought in 2013. So 2013, so same calendar year. So this is beginning, this is ending of the year. So repeating all the years. So now, at the beginning, the first year, remember, we apply the percentage with the cost. So the cost is 50,000. Okay, you describe this is particular column. So what is this 50,000 value is the cost. What is this value 40,000? This is the net book value. So after cost, I mean the first year will be cost, and then after that net book value, net book value, net book value. That is the particular. And then every year we provide depreciation. So that's why we put less depreciation. And you show the workings. This is first year. So first year you put 50,000 here. Can you put 50,000? Okay, 50,000 times 20%. So 50,000 times 20% is 10,000. Okay, so 50,000 minus 10,000, 40,000. So this is net book value in January the 1st, 2014. So December 31st, then we provide depreciation again. Now, less depreciation, then the value here based on the net book value. 40,000 times 20%. So remember, the note says second year onwards. So this is second year, third year, fourth year. So this is onwards. We use the net book value. Use net book value. Huh? So 40,000 times 20% is 8,000. So minus 40,000 minus 8,000. So net book value in 2015, 32,000. Okay, so the same thing at December 31st, we provide depreciation. Again, net book value 32,000 times 20%, 6,004. So put minus, don't forget. 32,000 minus 6,004. Net book value now is 25,600. Again, in 2016, December 31st, then we provide depreciation. Repeating every year. times 25,600, right down here, 25,600 times 20%. So 5,120 minus, so 25,600 minus 5,120, net book value 20,480. So this is net book value. And again, in 2017, December 31st, we provide depreciation. So write down 20,480 times 20%, equivalent to 4,096. Then net book value is 16,384 in 2018, January the 1st. Now, this was, we did not put the figure, okay, just for you to put on. I mean, so that you understand how to get the value. So you understand how to get this value, huh? Kelvin,
The
do you know how to?
depreciation usually set
Hmm?
20%.
Come again?
No, the depreciation usually the same for every year like that.
Percentage, you mean?
Yeah.
The percentage, yeah, it will be the same. Okay, this is the business entity policy lah. It depends on the business. So some 10%, some 20%. So this one is 20% lah. You see, this is reducing balance method. The amount is different. Every year, depreciation amount is different. 2013, 10,000. 2014, 8,000. 2015, 6,400. 2016, 5,120. 2017, 4,096. Different, isn't it? Unlike the straight line method just now, 10,000 every year. But this one, the amount of depreciation reduced from year to year. First year, higher, 10,000. Second year, reduced to 8,000. Third year, reduced to 6,400. Reduced to 5,120. And reduced to 4,096. So reduce. So that's why we call this reducing balance method. When we apply the percentage, we apply on the reduced balance. This is the reduced balance, 40,000. Isn't it? The net book value, reduced balance. That's why you need to write down here. In your answer, you must write down because this is part of your marks. Follow this format. Whenever you are asked to do the depreciation calculation using reducing balance method. So use this method. Now look at the effect. The effect of the reducing balance method. Decreasing amount of depreciation being charged to the statement profit or loss over the years. Higher expenses in the early years. So as you can see, like what I've shown to you, from 10,000 reduced to 8,000, 6,400, 5,000. So this is decreasing amount. That is the first effect. Okay. The second effect is amount of reduction in the value of the non-current asset in SOFP being decreased over the years. Higher reduction in the early years. So again, because when we record this into accumulated depreciation, so that accumulated depreciation reducing the non-current asset and higher reduction during the early years. Okay, the calculation. Any problem with this? Can you understand?
Yes, can.
Yeah.
Can, huh? All right. Now, we have 5 minutes break. Huh?
Okay.
Oh, so lagging.
Yeah, lagging.
So
No, we have.
presenting. Oh, break.
Yeah, we have break 5 minutes.
Oh, sorry.
Oh, probably my the message just now was lagging, is it? It was
Yeah,
late.
I didn't hear about. Sorry.
Oh, okay. Okay. So you guys can, think of how to do accounting program. You have, experience how to do the prime entry, then after that posting to the ledger. Probably you have the idea, program it. So everything will be, once you put in the transaction, so it can goes to a prime entry, then after that it will be posted to the ledger. Who knows? You can, come up with one program. That will be good. Think about
Yeah, I
it.
was thinking about that. Same sad for me.
Yeah, it's good. Let's say if you need some clarification, you can always ask me. So let's say not all you can do in one program. So meaning you have to separate it from, let's say, if it's capital expenditure, probably another different program. Posting is another different program. So you look into that now. Okay, Kelvin, you there?
Oh, yeah.
Put on the camera. Yeah. Okay. So we continue. So now we go on to the recording. How do we record the non-current asset? Huh? How do we record? Of course, we need the source document. We need what else we need? We need the prime entry. Yeah? So that's why the flow of depreciation cycle. Okay. So we must have source document because every transaction, it must be evidence. Okay. We want to be objective. Yeah. So everything is verifiable. So the source document normally, because this is no payment involved, there's no cash payment. So that's why you don't have cash bill or you don't have invoices. Okay. Instead, we only have memo. So memo is a document that is for internal communication, isn't it? You have learned that. So the memo will be written by the superior, the management, okay, regarding the method, what is the method and what is the percentage and the amount of depreciation. And then from the source document, of course, the prime entry, because it's not cash, it's not sales, it's not purchases, so it doesn't go to any of the six. Yeah, it's not cash book, it's not petty cash book. So therefore, but it still have to be recorded in the prime entry. So what is the prime entry? Meaning the general journal. So that's how you decide. So you look at the transaction. If the transaction cannot fit in any of the six prime entry, then you put into the general journal, because general journal can fit in anything. Right? So general journal, from general journal, this is our point of reference. Then we do the posting to general ledger. So it doesn't go to purchases ledger or sales ledger, but it goes to the main ledger. Yeah, that is general ledger. Now, source document. Okay, since the method of calculating depreciation is a decision to be made by the business owner, so the source document will be using memo. So what is memo? These are the written message, written note from the management to inform about decision on certain transaction. So we are talking about depreciation here. Then the prime entry will be general journal, okay, based on the source document, the memo. Okay, the depreciation normally is recorded on the last day of every month. Okay, let's say we do closing every month. So on monthly basis, so that's why accounts department, they always busy at the end of the month. So the last day of every month, they allocate this depreciation. Now, the reason why we use general journal, because of what I've said just now. It doesn't involve any cash. It doesn't involve check. Therefore, it cannot be recorded in the cash book. And it also not related to purchasing or selling cycle. So cannot be recorded in a sales purchases journal or written inward or written outward. Okay, so that is the reason, two reasons. And then the format of general journal. General journal is like journal entry, but journal entry is not prime entry. Can you distinguish that? Journal entry is only explaining, like what I've said to you before, only explaining the account to be debited and account to be credited. And normally the question will ask for the purpose of examining your knowledge on the debit and credit. Okay, so the format of general journal is using the journal entry format. So which is, we have a date column here, and then we have a particular column meaning the particular stating the name of account that is debited and the name of account that is credited. Now, when you put the name of account that is being debited, okay, you put to the left, yeah, justify to the left. And when you put the credited account, accumulated depreciation like this, okay, you put a little bit to the right. So can you see the gap here? Depreciation and the accumulated depreciation. So that distinguish between debited account and credited account. So you have to follow this format lah. Okay. So depreciation will be on the left. I mean a little bit to the left, and accumulated depreciation a little bit to the right. Okay, to differentiate debited account and credited account. And we have debit column, RM column, and we have credit column, RM column. This is where you put the value. Okay. How to remember? Like what I've said to you, depreciation is an expenses. Whenever you see depreciation, then think about expenses. So expenses is a debit item. So record on the debit side. And if there is a debit, there must be a credit. So corresponding entry must be credit. So since the depreciation is not actual cost that is being paid for, so we credit the accumulated depreciation. Okay, and then the bottom part, you put a narrative. This is narrative. Narrative means the explanation of this entry. The explanation here is depreciation of motor vehicle for the month of December. Okay. Any problem with this? Can you remember the format? Easy, isn't it? Okay, just remember this format. And then after the prime entry, the next thing is you need to post to general ledger. So this prime entry will be your point of reference. You refer from this. Okay, after recording the general journal, it will be posted to the relevant ledger account in the general ledger, namely the depreciation account, expenses account, and accumulated depreciation account. So adjustment to the trial balance and financial statement. So normally you are not asked in the exam for this, but I just explained how. So adjustment, meaning you have the existing trial balance, but since you are providing at the end of the month this depreciation, so you need to adjust your trial balance lah. Okay, let's say this is the only entry, so that's why we call it trial balance, and in bracket we call it extract, meaning we don't show the whole format of trial balance, but we only show the part that related with the depreciation and motor vehicles. Okay, we call it extract. Okay, so because of providing the depreciation, okay, we list down all the related on depreciation. That is the motor vehicle at cost, the depreciation that we allocated, and the accumulated depreciation we credited. And you will see this one is also a statement of profit or loss for the month ended 31st of March. And again, in the bracket is extract. So we only showing part of the statement profit or loss that is related with depreciation. So which is, remember, depreciation is an expenses. So expenses, like what I've said to you, every expenses we have to close off. Close off meaning we have to credit depreciation and we have to debit SPL, isn't it? So SPL, if it's debit because we are preparing in a statement form, so debit SPL is represented as less. So that's why less, and this is under the second type of expenses, expenditure. Then you put here, the name of the account is depreciation, and you put a remark, motor vehicles. Okay, so then put into the first column. So remember, like what I've explained to you, the column is to for us to do the adjustment first. Okay, so because depreciation we put on the first column because not only motor vehicle, but we have depreciation on office equipment, depreciation on fixtures and fitting. So we list down all the depreciation first in the first column. Then after we have the total, put on the second column. So the second column is where we list all the expenses type. So one of them is depreciation, and then followed by utilities, followed by salary, yeah, electricity. So we list down. Then after that, total expenses, then we put on the last column. Okay, so that is the reason why we have all this column, yeah. And we also have the statement of financial position and also again extract. So it doesn't give you the full version of statement of profit or loss, but only showing part of it, which is to show the accumulated depreciation on it. And the non-current asset. Okay, so this is non-current asset. So remember, in statement of profit or loss, we have to list down the asset first according to the type, non-current asset and current asset, isn't it? So non-current asset, and then we put motor vehicle, okay, in columnar form. So remember, the first column, second column, third column. So we put on the first column because not only motor vehicle we have, but we also have like office equipment, fixtures and fitting. So all has accumulated depreciation. So we have to use the first column to do the adjustment first. And once we get the net book value for each of the non-current asset, then we put on the second column. Now, the logic, why this accumulated depreciation is less? Okay, like what I've said to you, accumulated depreciation is using liability concept. Okay, why liability? Because I told you, when we allocate the depreciation, okay, there's no actual payment. But we must have a debit entry. So the debit entry is using liability concept, like you have not made the payment yet, isn't it? So that's why we say this is using liability concept. So by right, it should be listed, presented in the SOFP under liability. But then, since it is related with the non-current asset, so we are required to present it together with the non-current asset. But we change the symbol, less. Okay. So we have the illustration here. Okay, let's go through one by one. Okay, we have a trial balance. This is the question. Trial balance extract as at 31st of December. So meaning this will not be balanced because this is only extract. So on the debit side, all asset. On the credit side, all using liability concept. That's why freehold land on the debit side, 900,000. Building at cost, 500,000. And office equipment at cost, 160,000. Furniture and fitting, 150,000. And motor vehicle, 100,000. All these are assets. Right? Now, and we have accumulated depreciation. For the freehold land, there's no depreciation because freehold land is a land. Land, meaning it doesn't reduce value, but it appreciates. So that's why we don't have depreciation, accumulated depreciation. So this is using liability concept. It will be on the credit side. Okay. Now, the additional information given here. Freehold land is not depreciated because its value will appreciate, meaning instead of depreciating, it is increasing in value. Now, office equipment at cost, we are referring with this, include 60,000 of new purchase during the month of May 2017. Okay, so meaning in this number 2, okay, this is a new purchase, 60,000. But since the date is 31st of December, meaning inside this office equipment is already 60,000 added into that amount because the date, 31st of December 2017, new purchase during the month. Okay, that is the meaning. And then depreciation is to be provided as follow. Building 5% of cost. So 5% of cost, straight away, I know this is straight line method. How do I know? Because like what I've said to you, there are 2 methods that will indicate the straight line method. One is they give you the information on cost, okay, scrap value, and useful life. So meaning we need to apply the formula depreciation equal to cost less scrap value divided by useful life. And the other method is when they state like this, 5% of cost or 5% on cost. So meaning when we calculate the depreciation, so 5% like building, we have 500,000. So 5% of 500,000. Okay, 0.05 times 500,000. So you will have 25,000 every year. Okay. Now, next one, office equipment and motor vehicle at 20% of cost. Again, this is straight line method. I know this is straight line method. Office equipment and motor vehicles. Then the last one, furniture and fitting. 15% of written down value. Of written down value. So meaning this is reducing balance method. So how do you calculate the depreciation for written down value, reducing balance method? So remember, the percentage, yeah, that is 15%, you apply on net book value, isn't it? So how to get the net book value? So we are talking about furniture and fitting. So this is 150,000. So 150,000 you need to minus with accumulated depreciation of 22,500. So the net book value is 127,500. Then you times with 15%. Okay, so we will have 19,125. Okay, the depreciation. And information number 4, full year depreciation is charged in the year of acquisition. So meaning, what does it mean? So this is using calendar year. So if, let's say, we bought the asset like this one. We have bought office equipment on May 2017. So meaning they own this asset starting from May. Okay, May, June, July, August, September, October, November, December. By right, only 8 months. So if we are using monthly basis, we only provide 8 months depreciation. But because of this statement, number 4, full year depreciation. So we ignore the monthly. We charge depreciation 1 year, 12 months for that office equipment. Okay, that is the meaning. But no depreciation is charged in the year of disposal. So in the year of disposal, let's say this office equipment in year 3, they dispose of. So during the year 3 disposal year, no depreciation will be provided. Okay, so that is the meaning number 4. Now required, record depreciation for the year ended 31st of December in the appropriate book of prime entry. Okay, it doesn't tell you what prime entry. So you have to decide. Okay, what we have learned today, we know that this is not related with sales cycle, purchase cycle, not related with cash or check payment. Because of that reason, so the only prime entry will be general journal. That is to record, and then post the entry to the relevant general ledger account. So we have to open the account, the T account in general ledger, and then adjust the trial balance and financial statement. Now, the general journal. Okay, so meaning we based on this, record depreciation. So meaning we only record the depreciation. We only do the prime entry for depreciation. Okay, so that is why we have to do this at the end of the year. So look at the date. Everything will be December 31st, December 31st. Okay, at the end of the year. And it is repeating. We follow. So as you know, depreciation is expenses, so will be debited. Okay. If there is a debit, the corresponding entry must be credited. So where do we credit? Accumulated depreciation. So look at this. All is the same. Depreciation, accumulated depreciation. Depreciation, accumulated depreciation. Depreciation, accumulated depreciation. Okay. But the only difference is because we have how many assets here? We have freehold 1, 2, 3, 4, 5. So there are 5, but then 1 no depreciation freehold. So we have 4. Okay, so 4 entries in the general journal. So that is why depreciation. So you have to specify. So building, accumulated depreciation, building, and then office equipment, office equipment. Then after that, furniture and fitting. Then the last one, motor vehicles. Okay, class. Can you understand so far?
Sir,
Uh,
can go up to
Uh,
the additional information.
okay.
Number 3. So as long it the keyword say written down value means it's reducing balance.
Yes.
Oh, okay.
Yes. Because we only have 2 methods. One is straight line and one is reducing balance. So like in your notes also, it tells you this method also known as tax written down. So not tax written down, written down value, isn't it? So it's the same thing. Okay. So now the calculation. Okay, depreciation for building, okay, straight line, isn't it? 500,000 times 5%. So that's why 25,000. And the narrative, okay, the description of this transaction. So depreciation, you state, okay, the purpose of this general journal. Okay, journal entry for depreciation of building for the year. And then the second one, also the same thing, depreciation of office equipment for the year. So this is based on a straight line also, 20%, isn't it? 20% of 160,000. Furniture and fitting, okay, because tax written down value, isn't it? Sorry, not tax return, written down value. So written down value, so you need to minus the cost with accumulated depreciation, because the formula of net book value, you have to memorize it. Cost less accumulated depreciation. Okay, so 150,000 from the trial balance and accumulated depreciation 22,500 from the trial balance as well. So minus, then times 15%. So you will have 19,125. Okay, and the last one, the motor vehicles, straight line. Okay, 100,000 times 20%, 20,000, 20,000. So done. That is the prime entry. Appropriate prime entry. Okay, now we based on this reference as a point of reference, so we open up the general ledger account. But remember, class, in the trial balance, we have all this balance. So we have to reflect. Yeah, we already have opening balance. We have to reflect all this in the ledger account. Okay, so the debit side, this is an asset as what I've told you. So meaning you will have debit opening balance. On the credit side, this is all liability, isn't it? So we will have credit opening balance. So opening balance, normally the particular you write down as balance BD, isn't it? Balance brought down. Above the total, we call it balance carried down. So don't use balance carried down. Must be balance brought down. Okay, so that is why in general ledger, so building, okay, just hang on, I don't have my tablet pen. Okay, just put this now. Okay, so we record the opening balance first. First thing, your building. Okay, record this one first. Opening balance. Okay, record the particular product. Then next one, we have, if you look at the trial balance, building, we have accumulated depreciation. So we record the opening balance first. Okay, and then office equipment, we have debit balance. We record the opening balance first. That is the first step. And then depreciation is an expense, so we don't have opening balance. But accumulated depreciation, we have the opening balance. Now, office equipment, the opening balance is different because of the notes number 2. Okay, if you look at notes number 2, office equipment at cost includes 60,000 new purchases. So meaning when we have opening balance for the office equipment, of course, it's 100,000. Okay, but in the trial balance is 160,000, as what I've told you, because of the date of the trial balance. Okay, the date of the trial balance. Look at the trial balance here. Because of this date. So I know this amount, yeah, the office equipment here, 160,000 already inclusive of the newly purchased. So for opening balance of this office equipment cannot be 160,000. We must put lesser than, take out the newly purchased, which is the notes number 2. It says during the month of May, 60,000, isn't it? So that is why when we open up the office equipment, yeah, in the general ledger, so we record 100,000 here. Because look at the date. This is January the 1st, not 31st of December. So January the 1st, 2017. So that's why we must put 100,000. Okay. And then the accumulated depreciation for office equipment. And then opening balance for furniture. And then accumulated depreciation for furniture and fitting. Record. And the last one is motor vehicle opening balance, debit, and then accumulated depreciation. Now that is opening balance. Okay, Anna? Any question? We haven't record according to additional information and the depreciation yet. So only the opening balance. So that's how we record. Okay, Anna? Any question? Can understand?
The newly purchased office equipment, do we need to depreciate?
Yeah, we need to depreciate. So that's why
Okay.
when we depreciate just now, we use, because this is using straight line method, isn't it? So we times the percentage on 160,000, which this 160,000 is already inclusive of the newly purchased. Okay, so now we record the additional information first. So only office equipment has additional information, that is number 2, which is newly purchased on May, so record, yeah, the date, May 31st. Okay, and then paid by check. Yeah, so we record the particular as bank, and then the amount is 60,000. Okay, so no more transaction on this is the capital expenditure we record in the asset. So now we record the depreciation. So the depreciation, okay, referring with the journal entry just now, okay, we debit depreciation. So the first one is building. We debit depreciation. This is debit, 25,000 in depreciation account. And we credit accumulated depreciation, 25,000. So this is we referring with the general journal just now. Okay, 25,000 debit depreciation, 25,000 credit accumulated depreciation. So in depreciation account, the particular, you write down the name of account that is being credited and the date, the last day of the year. In accumulated depreciation building, okay, we write down the name of account that is being debited. Okay, and then next one is the second journal entry. We have depreciation on office equipment. Okay, again, we debit the 32,000 already been calculated, yeah, and we credit accumulated depreciation, 32,000. So it's repeating, very simple, isn't it? So again, the particular in depreciation account, so should be the heading of account that is being credited, and the particular in accumulated depreciation account, the heading will be the name of account that is being debited. And moving on to furniture and fitting, depreciation. So we debit, okay, 19,125 into furniture and fitting, and we credit accumulated depreciation furniture and fitting, 19,125. Okay, again, the particular repeating. So in depreciation, so it should be the name of account that is being credited. In accumulated depreciation account, the heading, the name of the account that is being debited. Okay, and the last one, motor vehicle. So we have we refer from the prime entry. So 20,000 debited into depreciation and 20,000 credited into accumulated depreciation motor vehicle. Okay, and the particular in depreciation you put accumulated depreciation. In accumulated depreciation, the particular you write down depreciation. Okay, so done with the depreciation. Now we do balance off and carry forward. Balance off and close off. So like building, okay, we have to balance off. So no other transaction. So put, okay, 500,000 on the credit side and do the double line. Okay, this will be balance CD and then balance BD the next following year on the debit side. Then depreciation, we have to close off. Okay, so close off all the expenses, close off. Only depreciation is expenses. So this one also close off. And depreciation, furniture and fitting, we close off. And depreciation of motor vehicle, we close off. That is closing off, only expenses. So asset and liability, that is motor vehicle accumulated depreciation is liability. So we have to balance off. Now, can you understand that?
The accumulated, usually they get all the depreciation together, not just one. Oh,
Yeah, because the depreciation that is being allocated to SPL on yearly basis will be accumulated to this account. So this
Mm.
account will be carried forward. So that's why we have credit balance here,
The
52,000.
accumulated depreciation.
Mm.
The depreciation of the office equipment asset, where can you scroll?
The depreciation of office equipment, this one,
Yeah, this one's only for 1 year only. So
this one is only for 1 year. But
usually,
what we have, allocated previous year, okay, we already have 20,000 and plus with the current year, 32,000, and this will be carried forward to the next following year again.
Oh.
And then again, when we provide during following year depreciation, so we do the same thing. We debit depreciation and we credit again, accumulated.
Okay.
Okay, what about the balancing off? Can you understand this? I just explain one, okay, and then that represent the rest. Okay, like motor vehicle, probably the furniture. This one lah. I explain office equipment, so that represent how we close off, how we balance off the asset account. Now, so no more transaction. Okay, so we put the line, okay, single line on the top, and the bottom line, double line, and it must be in the same row on the credit side. So same thing, single line on the top and double line underneath. And then select the highest amount. So debit is highest amount. So we put 160,000 for both sides. Debit 160,000, credit 160,000. Then in order to make total credit 160,000, so we put this 160,000 on the credit side. And the particular, you write down balance CD. So this is above the total balance CD. Below the total, this is total. Below will be balance BD. So this is what we call debit balance. This is debit balance. Look at balance BD. The location is on the debit side. Okay, because you see, the total debit is 160,000. Total credit zero, isn't it? So that's why we called it debit is more than the credit by 160,000. So debit balance. Okay, that is for office equipment, asset, debit item. What about the credit item, the liability? So accumulated depreciation. Yeah. So we don't have this yet. So the only thing that we have is this credit, yeah, opening and the depreciation. So we make a total single line. So it must be the same row on the top and then double line underneath. So we select 50,000, okay, the total credit as a total for both sides. So 50,000, 50,000. Okay, and then in order to make the total debit 50,000, so we must put the 50,000 this side, okay, and then the particular you write down balance CD. Okay, what is balance CD? So balance CD is a debit balance, yeah, debit balance, which is debit total is more than the credit side for 50,000. Okay, so this is credit balance. Look at the location of balance BD on the credit side. Okay, is it clear? Now, if it's clear, then the next thing is we do the adjusted trial balance. So this is an extract, meaning you don't have a full version. So that's why we don't have the value, total value, because if we have total value, it will not balance, because we don't have full version of trial balance. So just showing to you how do you record, in adjusted trial balance. So trial balance, remember, is a listing. So meaning if it's close, I mean, expenses also we list down here. Yeah, liability, asset, everything will be listed here. So asset, of course, all on the debit side. Accumulated depreciation and depreciation. Sorry, accumulated depreciation will be on the credit side, but depreciation is an expenses, so you put into the debit side. Okay, list down for all that you have provided just now. So meaning we have adjusted the trial balance. So initially, when we have a trial balance, we only have the asset and the accumulated depreciation without the current year depreciation. So when we do the adjustment, we have calculated the depreciation, then we will have adjusted trial balance with all the depreciation we have provided for the current year. Okay. Now, we were asked to do the statement of profit or loss extract. So meaning we don't show full version of statement profit or loss, but only show part of it, which is related with depreciation. So that is why. So we only have less expenditure here. Then you list down all the depreciation. We have 4 assets that is being depreciated. So building, office equipment. This is to complete as we close off the expenses account, isn't it? Okay, we have building 25,000. So this is debit, but since we are using presentation form, so we don't see debit and credit, but less and add only. So less representing debit. So 25,000, 32,000, 19,125 for furniture and fitting, and the last one is motor vehicle 20,000. And in the statement of financial position, extract also. So we only showing the part that is related with the motor vehicle cost. Sorry, the non-current asset cost together with the accumulated depreciation. Okay. So the first column is to do the adjustment on accumulated depreciation. So building 500,000 minus 50,000. Office equipment 160,000 minus accumulated depreciation. Furniture and fitting, okay, minus 41,625. Motor vehicle minus 40,000. So the net book value then you put on the second column. So for freehold land, because there's no accumulated depreciation, so we just put the net book value into the second column. So we list down. So we add all this together, then put on the third column. So this amount put on the third column.
So if appreciation, we don't need to record.
Come again?
If appreciation,
Appreciation.
Yeah.
Appreciation, you don't show it here. It will be shown in the individual account. Let's say if you have appreciation for freehold, meaning it is increasing the building, isn't it? So it will be debited. Let's say 10,000. So we debit here 10,000. So your balance CD for building is no longer 500,000, but it will be 510,000. Can you understand?
credit what? Yeah?
Debit
If
building and credit revaluation.
Oh, okay. Is this covered in this syllabus?
No.
Oh, okay.
Okay, revaluation is a reserve. So that is another part. So don't think about that. That one is more further topic. Okay, so far, can you understand all this?
Oh, yeah.
Okay.
Correct?
Yes.
Hmm?
Yeah. Can.
You sure? So get yourself prepared for the test. So try and score as high as possible. Huh? So we will do it on Friday night. So use the time properly. Okay. So if you have no other question, then that's all for today. I'll see you next week.
Okay, thank you, sir.
Okay, sir. Thank you.
Okay.